When you think back to 2008 and how giants like Lehman Brothers just vanished, it wasn't just some random market crash. It was a complete failure of risk management. So today, we are going deep inside the world of our financial institutions. It really is the ultimate balancing act. On one side, you have this relentless pressure to make a profit, and on the other, you have the absolute, non-negotiable need for safety. Get it right, and the economy just hums along. Get it wrong? Well, we've all seen what that looks like.
Okay, this quote just hits the nail on the head, doesn't it? It perfectly captures that dilemma we're talking about. If you play it way too safe, your bank doesn't grow, your shareholders get mad, and you eat poorly. But if you swing for the fences, take on way too much risk, you could just blow the whole thing up, and that lands you, and probably a lot of other people, in the ranks of the unemployed. This is the razor's edge every single financial manager has to walk every day. So, here's how we're going to break it all down. First, we're going to look at that core conflict, profit versus safety. Then, we'll dive into three huge risks every bank faces: running out of cash, what happens when loans go bad, and that wild ride of changing interest rates. And finally, we'll open up the modern-day toolkit they use to try and manage it all.
All right, first things first, let's talk about this fundamental battle. Because every single decision, from a tiny business loan to a multi-billion-dollar investment, it all comes down to this: weighing how much you could make against how badly things could go wrong. It's really the DNA of all financial decision-making.
This is the multi-trillion-dollar question, isn't it? How do they actually do it? How do they manage these incredibly powerful competing demands day in and day out without falling off? So you've basically got these two powerful forces pulling in opposite directions. You've got your shareholders on one shoulder, and they're screaming for higher profits for a better stock price. But on the other shoulder, you have depositors, creditors, and of course, the regulators. And all they care about is that the institution is rock solid and can pay its bills. The manager's job is to somehow stand right in the middle of that tug of war. And look, when that balancing act fails, things end in one of two ways. Insolvency, well, that's just being flat broke. Your debts are worth more than all your assets combined. But illiquidity is sneakier, and it's just as deadly. It's like owning $1 million house but having zero cash to buy groceries. You have assets on paper, but you can't pay your bills today. Either one is a death sentence for a bank. So let's zoom in on that no cash for groceries problem. This is what we call liquidity risk, and it is maybe the most immediate threat a bank faces. It can bring down even a really profitable company in just a matter of days. This is the nightmare scenario you've seen in the movies, right? The lines of people outside the bank, all demanding their money back at once. If you can't hand over that cash right then and there, confidence just evaporates. It doesn't matter how good your other investments are. If you can't meet today's demands for cash, the game is over.
So how do you prepare for something like that? Well, the old school way is what we call asset management. You just keep a big pile of cash and other stuff you can sell super quickly. But the more modern approach, liability management, is kind of like using a credit card. You don't hoard cash, you just plan to borrow what you need right when you need it. Now that's more efficient, but it's way riskier. Because if those lending markets freeze up, which is exactly what happened in 2008, your credit line is suddenly gone.
And this table really shows you the fundamental headache of asset management. Just look at the top line. Primary reserves. That's basically cash in the vault. It's perfectly liquid, but what does it earn you? Nothing. It's dead money. Now, look down at the bottom. Bank loans. That's where a bank makes its real income, but they're the least liquid asset. You can't just call someone up and ask for their 30-year mortgage back tomorrow. So every single dollar you keep around for safety is a dollar that's not out there earning a profit. It is a constant, painful trade-off.
Okay, so let's talk about those really profitable but not so liquid loans. What happens when the people who took them out can't pay them back? That's credit risk. And you have to understand, these two things are deeply connected. If a whole bunch of borrowers default at once, not only does the bank lose money, but depositors might get nervous and start a run on the bank, creating a liquidity crisis. One problem can so easily trigger the other.
At the end of the day, you have to remember that lending is risk. Every single time a bank makes a loan, it's placing a bet that the borrower is going to pay it back, with interest. The entire art and science of banking is just trying to get the odds on that bet right, over and over and over again. Think about it this way. Say a small business comes in asking for a loan. First, the bank does its homework. That's the credit analysis. Then, if the loan is approved, they don't just forget about it. They keep an eye on the business's health. If that business starts missing payments, they've identified a problem loan. That's when the bank steps in. Maybe they can restructure the terms, or in the worst-case scenario, they have to move in to recover whatever money they can. It's an active process from beginning to end. And this is a really, really important point. One small business loan going bad, that's a bummer, but it's a manageable loss. But what if you've loaned billions of dollars to an entire industry, say commercial real estate in one city, and that whole sector just completely tanks? That is how individual problems suddenly become a systemic crisis.
So the number one defense against that happening is diversification. Banks use a tool called concentration ratios. Think of it like a doctor telling you to eat a balanced diet. You can't just eat cheeseburgers all day, every day, right? A bank can't just lend to one industry or one part of the country. They have to spread their bets across the entire economy.
Okay, so you've managed your cash flow, you've diversified your loans, you think you're safe. But there's this other, almost invisible force that can sink your ship, the constant up and down of interest rates. So, welcome to the roller coaster.
So what's the big deal here? Well, imagine you promise to pay your friend a fixed amount of money every month for a year, but your own salary to change every single week. See the problem? That mismatch is exactly what banks face. A lot of their assets, like a 30-year fixed-rate mortgage, are locked in for a long time, but their liabilities, like what they pay on savings accounts, can change almost instantly. This creates what they call a gap, and that gap is a huge source of risk.
So managers use a tool called the maturity gap to measure this. And it sounds complicated, but it's actually pretty simple. They just ask a question. In the next, say, 90 days, how many of our assets are going to have their interest rate change, and how many of our liabilities? The difference between those two numbers, that's the gap.
And managing that gap, it's kind of like sailing a boat. You have to adjust your sails depending on which way you think the wind, or in this case, interest rates, is about to blow. If you think rates are going up, you want more of your assets to reprice higher, and quickly. If you think rates are going to fall, you want to lock in your high-paying assets for as long as you possibly can.
But what if you can't just restructure your entire loan portfolio overnight to adjust your sales? What if you're stuck with a gap that you really don't like? Well, that's when you have to turn to the really advanced financial toolkit for something called hedging.
Hedging is basically just buying financial insurance. You make a kind of side bet that's designed to pay off if the main part of your business gets hit by something bad. The goal is that the money you make on your hedge cancels out the money you lost on your portfolio. But just like with any insurance, that protection, it isn't free. It costs money.
And these tools can get pretty sophisticated. A financial future is like a farmer agreeing today on a price to sell his corn in 3 months, no matter what happens to the market. An option is kind of like putting a non-refundable deposit on a house. You have the right to buy it at that agreed-upon price, but you don't have to if the market crashes. And an interest rate swap? Well, that's like two people, one with a fixed-rate mortgage and one with a variable rate, agreeing to make each other's payments because it suits both of their financial situations better.
So as we wrap all of this up, what's the big takeaway? It's that risk management is not a problem you solve once and then forget about. It is a perpetual, continuous balancing act. It takes constant analysis, constant management, and the willingness to adjust course the second the world changes.
Which really leaves us with one big final question to think about. Our global financial system today is more complex, and it moves faster than at any other point in human history. The tools we have to manage risk are more powerful than ever, but so are the dangers. So you have to wonder, in this incredibly fast, interconnected world, are the balancing tools we have today really strong enough to prevent the next big fall?